Good afternoon, and welcome to the sixth in a series of energy topic webcasts hosted by the University of Oklahoma's Energy Institute. My name is Harry Pafanis, and I'm the President and Chief Commercial Officer of Plains All American Pipeline, and also a 1979 graduate of the Price College of Business here at the University of Oklahoma. Today we'll be visiting with Hunter Hunt, Chairman and CEO of Hunt Energy, to get his views on the energy industry, particularly his views on the future of both renewable energy and hydrocarbon-based energy. By way of background, Hunter is a graduate of Southern Methodist University with degrees in both economics and political science. Prior to joining his family's company, his career included stints in investment banking and in commodity trading in both the US and the UK. Today, he leads all the family's activities related to energy, both in the traditional realm of hydrocarbons and in the growing space of electric power and renewable energy. This makes Hunter uniquely positioned to speak with us today on what most folks are calling the energy transition, or as Hunter likes to call it, the coming energy addition, heavy emphasis on the add. Hunter, it's nice to have you with us today, and thanks for taking the time to visit with us.
No, thank you, Harry, for having me. I'm excited about the dialogue we're about to have.
Same here. So let me start with your views on oil and gas investments. Your family has ownership interests in upstream oil and gas production, downstream refining assets, and LNG export facilities. In this environment, do you see investment opportunities in any of these segments?
So we do, Harry. It's interesting. I think it's fair to say at $40 oil, I'm not sure who, if anybody, is really making money. I mean, certainly the U.S., most of the shale plays in the U.S. Can't make a competitive return at these prices, even if on the marginal basis, it may still be attractive. On a full cycle basis, $40 just doesn't really cut it. And so I think it's part of the reason why you've seen production in the U.S. fall from close to 13 million barrels a day at the beginning of the year down to below 10 today. So on the one hand, it's challenging in the current price environment. Overseas, I think it's quite the same. It's difficult to see how dollars invested today actually return anything too quickly. But actually, my brother-in-law, Chris Kleiner, who looks after the investment side of the portfolio, has the saying that the best cure for low prices is low prices, and that's what we kind of think today. In our mind, the question is a little bit less, what's the price now than what's the price when we'll be producing the oil or natural gas over the coming decade. And we really do think this period of low prices that we've been mired in a little bit, as you know, since really 2015, is going to set up a nice rebound over the coming decade to see higher prices. So we're interested actually in deploying more dollars into the space right now. I think the tricky part is figuring out where are the best options for value and what, when we look back 10 years from now, what are those assets that we think make the most sense to have as part of our portfolio, just given how different conventional oil is from unconventional, how different the international opportunities are from those here at home.
Thanks. And boy, you're right. It has absolutely been a tough environment for the last several years. One thing I will say is the upstream industry over the years has been pretty resilient and pretty innovative. If we stay in a $40 to $50 price environment, say in oil, and maybe a $2 to $3 natural gas environment, is that a price level where we can develop the resource base in the U.S., or do you think we really do need higher prices to develop our resources?
Yeah, so it's a great question. I guess it's the question a lot of folks are trying to sort through. Our belief is that it doesn't work at these levels. The shale plays are fascinating because the cost structure and the way that the investment dollars roll out the door are so different than conventional plays. At one point, about a decade ago or so, we had a very large project in Peru that's conventional. And so, we started spending material dollars in the year 2000, and all we did was spend for 4 years until August of 2004. When we completed a pipeline to bring gas and natural gas liquids over the Andes and back down into Lima. and when the upstream development was complete and the pipeline was complete, we turned to valve in August of '04, and then we had cash flow. We had lots of revenue. So it's a classic J curve that we all know. In the renewable space, it's interesting because you have the acreage, you have not just one well to figure out what you have or several wells. You really have to drill quite a bit to have a full understanding of the acreage position and how prospective it is. And and yet the very first well that you drill, you have operating cash flow and earnings. And so it's a very odd deal where you're still spending a lot of capital at the same time that you're posting operating profits and net income. And yet at one point when we pulled our J curve in the Bakken up in North Dakota, and we pulled our J curve from Peru, they looked eerily similar to each other, even though from an operating cash flow and earnings perspective, they look quite different. So I say that because I think there was a lot of investment dollars that flowed into the unconventional space, and there are a lot of metrics around operating cash flow and earnings that look quite robust for a while, but they just kept consuming cash. And so, you fast forward to really about a year ago. I mean, you'd already started having questions from a lot of the investors saying all of our dollars have gone out the door. When are we going to get them back? When do we start seeing a return? So about a year ago, we were already seeing a lot of the private equity saying that this model's not working for us. You hadn't really seen too much consolidation at that point going on in the industry, creating longer term pure play shale players that we would say would be really robust over the long term. And so it seemed like it was an investment thesis that was under a lot of fire in February of this year. I think COVID has just simply accelerated that. So, you fast forward to today, but again, we certainly aren't making any kind of return that we would be proud of in a $40 to $45 world. I think the private equity game as it was being played is over. You are seeing the consolidation move forward now, but a lot of that is defensive, as you would expect. And we don't know where the new money is really going to come from outside of, as you know, the majors have moved in, but even then it's at a much more measured pace, and they have a very broad portfolio to spend their dollars across. So we don't think you're going to see the rejuvenation of the unconventional resources in this country in a sub $50 world. And as you look across the rest of the world too, I don't know if it really works for Saudi Arabia or a number of the other countries, a number of the petrodollar countries that are out there as well. So we think that this is a classic cycle, that you're going to end up with underinvestment in the space for another few years, but that ought to be setting up the mother of all price booms coming out of this, because we don't believe that oil is peaking anytime in the near future.
That's interesting. Appreciate your comments and thoughts on that. And I'll just highlight what you said a little bit with some of the experiences we've seen. Is you're really seeing a new metric being driven by investors, and it's free cash flow.
Yes.
And your comments about the J curve being very similar between an investment overseas in Peru, a long-term investment, and what is typically thought of as a shorter-term cycle in the Bakken is pretty surprising.
It is. It surprised us.
Yeah,
it kind of forced us to look at a different model for our unconventional. So we did a modified Drillco structure in the Permian. We partnered up with Texas Pacific Group, and it worked out well for both sides. It wasn't your traditional Drillco in that we put up a small percentage of money. We actually put up quite a big percentage of the money, but we were looking for ways to increase the velocity of dollars, for lack of a better word, because those J curves are they're hidden by a lot of earnings and operating cash flow, not free cash flow. In the resource plays, but it's painful when you get too far down the J.
Hey, so listen, you touched on your investment in Peru, and I know you have an export facility in Peru, and also you have an investment in Yemen as well. These are both resource-rich countries. They probably have some logistical advantages to exports from the U.S. So, two questions come to my mind as you look at those areas. How competitive do you think U.S. exports of LNG can be compared to exports from those countries in the long term? And then secondarily, listen, there's a lot of gas potential in the U.S. and in the world. And when you sort of look across the pond at Europe, you see efforts to move more towards renewables and away from hydrocarbons. Mm-hmm. So it makes you sort of think that the long-term market is the Far East. Does that make sense to you? Do you have different thoughts? And if it is the Far East, can that area absorb sort of the potential for LNG exports out of different parts of the world?
Yeah, it's a great question. About we tend to be a little bit bearish on natural gas, certainly in North America from a pricing perspective, and we become increasingly more so globally. Although there are more moving pieces from a global perspective. But about 13 years ago, our head of technology put up a very simple 2x2 matrix, and on one axis was, does the energy source, does it support mobility, or is it stationary in nature? And on the other side was, does it require new infrastructure, or can it utilize existing infrastructure? And then he populated it with all different kinds of energy technologies, wind, solar, batteries, nuclear. At the time, small scale modular nuclear was trying to be developed, ethanol, hydrogen, natural gas, obviously. And one thing really jumped out of that, the only technology, the only fuel source that could both support mobility, which was a great trend of the 20th century, and even with COVID, I think we're going to see it continue in the 21st century, that could utilize existing infrastructure, was the internal combustion engine using oil effectively. And what the interesting thing that jumped out of the slide is the primary use of natural gas is stationary, as we know, and a lot of its growth was driven by power generation. And so natural gas has had an incredible run when it's going after coal to displace in the power generation stack. And that's what drove North American growth, the 2x1 combined cycles that we saw being built all throughout the country, displacing older coal plants that have been retired. And so that is the play, I think, in Southeast Asia. That is where I do think, to the degree that there's been a driver of LNG growth, it has been over in Asia, where they had tremendous economic development. And it's been used in most instances to supplement coal as opposed to displacing older coal plants. The interesting thing, though, is it's stationary. And so it actually directly competes with both wind and solar, both of which are intermittent, so they have their own issues. But the more that those have been kind of coupled together into an energy stack of a country, and with batteries coming on very quickly, you could actually, you're starting to see a scenario where it's harder for natural gas to simply pick up 100% of the either the coal retirements or the incremental growth. Solar and wind have been on a tear across the globe, over the last, certainly over the last decade for wind, and increasingly so on the solar side. So we do think the growth for LNG is going to be driven mostly out of Southeast Asia. In fact, over the next 4 to 5 years in particular, you're seeing India kind of play the role that China used to from an incremental demand perspective. We think there's a lot of running room there. You're seeing it in Pakistan as well, populated countries that are climbing the development curve and need more electrons. And Yemen is certainly better placed than either Corpus or Louisiana for deliveries into India. So we like the geographic location from that perspective. But we're absolutely keeping an eye on, are you actually going to see renewables put a dent into natural gas potentially quicker than they would put a dent into oil demand?
So that's interesting. So if you were to fast forward 20 years from now, are you saying that you see more exposure to gas investments than oil investments, recognizing that renewables probably do take a larger percentage of the energy complex than they do today?
So again, this is where we wish we had a better crystal ball. But Harry, to your point, so if you rewind the clock about 10 years ago or so, there are a number of people that kind of view natural gas as the bridge fuel, right? The bridge into the future. A lot of environmental groups actually said, well, we need to be promoting natural gas because it will be the supplement. It'll firm up the intermittency that you have with renewable power. And certainly, as it's been displacing coal, the environmental benefits are very clear. So, I think there was a very positive trajectory it was on. We again, from a power generation side, we think there's a lot of pressure on natural gas, as solar costs are now plummeting at the same rate that we saw wind plummet, about 15 to well, really over the last 20 years. Solar is peak, basically. It's a daytime performing fuel source. And so it competes directly with gas peakers for the daytime peaks that you typically see in most areas of the country, the country in the world, where the primary consumption of power is during daylight hours or right when people come home in the evenings. And so, that seems more problematic to us. Oil, on the other side, we're a little more bearish than a lot of the bulls on the electric vehicles, on the EVs. They're clearly coming, and they're coming at a quicker rate than I think what a lot of people in the oil and gas industry may think. But I think they're coming far slower, potentially, than what the true believers might be forecasting right now. And the strength of oil is it's used in multiple different applications. And so, even as you put gasoline under pressure from EVs, you still have 60% of the barrel going towards other applications, all of which are critical right now. So if we had a 20-year investment for natural gas, that we really kind of needed the full 20 years to capture what we thought were the true economic benefits, or a 20-year cycle on oil, we would actually choose oil right now as a company.
Yeah, that's interesting. I think most people do think that natural gas has more growth potential. But let me touch on something else. You've mentioned power generation a couple times. Listen, the Hunts have been in the oil and gas business for decades. A lot of name recognition in the space. Tell us, how did the family get involved in the power business?
I was the one responsible for either bringing it or inflicting it onto the company. But I joke my career kind of it mirrors Forrest Gump, basically. I graduated from school in 1990. I started in the natural resources group of Morgan Stanley the week that Iraq invaded Kuwait back in the summer of '90. And then went over to Europe in the mid '90s, and I stumbled onto the trading desk with electricity. I was actually meant to be a petroleum products trader with Morgan Stanley, but for various logistical reasons that was held up. So they said, "Look, this power market thing's opening up. Go figure it out." And so I never left that. And came back to the U.S. To help when the U.S. market opened up. The U.S. market opened up about 6 years later than the U.K. market did. And meanwhile, my father was obviously, Hunt Oil Company was still blowing and going at that point. But he went to a CIRA conference back in 1998, and he was listening to all of the dialogue around the convergence of natural gas and power generation and electricity and spark spreads. And then he was listening to utility CEOs standing up, talking about how with this new deregulation wave that was coming, they were going to conquer the world. And he literally called me from the conference and said, "Look, I'm sitting here, I'm listening to all this." And I'm like, "I've seen this movie before. It happened in natural gas in the 1980s, and it had a surprise ending for most folks." And so he said, I'm telling myself there must be a role for an independent, like Hunt is in the oil sector, that's contrarian to play in the power generation space. And so I think we'd like to get into it. Do you know about anybody who'd be interested? And I said, "Well, actually, I wouldn't mind that job." And so that's when we started up in the power side. And ironically, again, just from a contrarian perspective, we ended up not investing in power generation, which at the time was really pretty hot in the late '90s. We went the other route and invested in the regulated transmission and development. We started up an electric utility down in South Texas, and it really spent the last 2 decades growing that. So it was, in some ways, it was a reaction to the evolution of the energy markets, Harry, in the sense of Dad saw that this is changing, and he'd seen this movie before. I think in other ways, again, as a private company, there are a number of disadvantages of being private, but there are a few advantages. And one of them is, especially as a family owned company where it's multi generational, it forces you to keep an eye on the horizon and try to figure out what's next. And yeah, I think the whole family realizes we need molecules for our lives. We need molecules for mobility. Coming back to, there's really nothing that can compete with the internal combustion engine at scale right now. But more and more people want electrons. They want things to plug in as opposed to things to fill up. And so, with that being the case, it made sense for us to go ahead and start evolving our company to include that in the overall mix as well.
Wow, that is impressive. And you're probably right. It probably is a little easier for a private company to navigate that change in direction than a public company that has a host of investors to deal with. But very insightful. But
yeah, Harry, I joke. I have our investment committee has one member. He's known me for 52 years, and he walks around on the 8th floor. So it's a lot easier to be contrarian when that's the case, as opposed to having Wall Street as your best friend.
That's definitely true. Hey, so I've got to ask you this: whenever people talk about the future of power generation, renewables are always part of the dialogue. But you seem to always hear that renewables are only competitive because of government subsidies. I'd love to hear your views on the economic viability of renewable power, and can you grow renewable power without government subsidies?
The short answer to that is we firmly believe that renewable power is not only here, that it has many attributes that ultimately will cause it to win versus hydrocarbons. But we think it's a much more nuanced story, and it's in some ways it's going to be an incredible clash that we're going to watch over the coming 2 decades. I think in particular, renewables have needed a lot of subsidies to get off the ground. I do remind all of our hydrocarbon friends. Last I checked, I do think there are a few tax breaks for oil and gas development in the U.S. Percentage depletion and your G&G expenses kind of come to mind. And so there are tax advantages that are there. Probably the biggest subsidy that I've always remarked on is if you take the U.S. defense budget and you take it in its totality, and then you look at the global population, and you basically divided that to defense dollars per capita globally, and then look at what we pay defense dollars per capita in the Middle East, presumably driven mostly by security of oil. Whatever that premium is, if you turn around and attributed that to consumption of fuels, well, then all of a sudden you have clear cost transparency about what exactly is it costing for the world to be on a global oil system. So I'm not a big fan of folks that get all high and mighty with the renewables industry from a tax perspective, because the oil industry has had its breaks along the way. What I do think, Harry, is this: so what's been built in oil and natural gas is it is the greatest achievement humanity has ever had. If you take the giant step back and you go back to February, every single day, 100 million barrels that have been discovered over the previous decades, or at least years, have been pulled out of the ground, shipped, as you know, to refineries and processing plants, across the world, cracked open into various different products, and then turned around and distributed to 7.5 billion people across the face of the planet, exactly how they wanted them, exactly at that time. I mean, it is stunning. It puts Jeff Bezos to shame. It is the most omnipotent, ever-present system that we've ever created. And then, on the other side, you have Elon Musk showing up and saying, EVs are going to change everything. And I don't see it happening in the short term. The flip side of it is renewables they're declining cost curve industries. We know with certainty that in January 1st of 2021, the prices of wind, solar, and batteries are going to be cheaper than what they were at the beginning of this year. And we know the beginning of 2022, they'll be cheaper still. it's a modification of what we've seen across all technology industries. The price is going to continue to get lower. And as we know, in the oil and gas world, we've had years or even decades of increasing marginal costs or decreasing marginal costs in order to balance the system. So we are up as oil and gas companies, we're up against an industry that is just going to continue to get cheaper and better every single year. The flip side is they have wholly underdeveloped supply chains, distribution chains, waste chains, not to mention step up manufacturing bottlenecks that are going to appear along the way. And so we look at the renewables and think they are wildly overhyped relative to what they can deliver in the near term. And by the near term, I really mean over the coming decade, if not decades for some true believers, but they're coming. And they, in many ways, they're already here. So that's a long-winded answer to the question of, there are a number of people that say, take away the subsidies for wind right now. In fact, actually, a number of the large wind folks don't want any subsidies for it because they're already entrenched and have the economies of scales of those technologies in their favor. It's coming in solar as well, very quickly.
That's interesting. You raise a lot of points that people just take for granted. You need gas in your car, you just go down to the corner and fill it up with gas. You need light, you flip a switch. Nobody ever thinks about what it took to get that molecule into that place.
Well, you know that very well. It's a lot more complicated, I think, than what people think.
Exactly. Hey, you touched on this earlier a little bit, but we both live in Texas. I'm pretty sure Texas has more windmills than any other state in the country. But how do you address two things? One, the inconsistency of the wind. And then second, a lot of those windmills are in remote locations. How do you get that energy to, demand areas like Dallas or Houston?
So you're right, Harry. If we were our own country, it would be the 5th largest wind generating country on the face of the planet. We have over 25 gigawatts of wind capacity in a market that peaks around 75,000 megawatts of demand. So we have tremendous wind resources and more still on the books, more still coming. It is intermittent, to your point. And that's been the challenge with it. All that said, people said once upon a time, well, when renewables hit 10% of a grid, the grid would become unstable. If they hit 15%, they become unstable. We've actually we've had several months where I think it was March of 19 when a third of all electrons across the totality of the month were wind. 1 out of every 3. And so, as we sit here today, batteries are still very, very new and very, very small in the state. And so the way that wind has been firmed up has been with natural gas, but it's worked. And I think we aren't alone as Texas. There are a number of other grids that I think have been surprised with how much intermittent, wind capacity you can put on the system. The challenge here in Texas, but I think it's probably everywhere, is people don't like to live where it's windy or hot. And so, a lot of the best places for wind and solar are not where the population areas are. And so you have to move it. And, we were blessed with great political leadership in the middle part of the 2000s that basically said, when you go into a regulatory proceeding, you have to both prove that what you want to build from a utility perspective is necessary, and then you have to prove kind of the convenience that you've chosen the best route relative to other alternatives. And there's very much of a chicken and egg with wind. Until wind people said, "Yep, we're going to build," you couldn't prove a line was necessary. And of course, the wind folks they were saying, "Well, if we don't have a transmission line, then we aren't going to build there." And so our legislature in the state actually they passed a law that took out the necessary part. They basically said, we're going to develop when the Public Utility Commission is going to figure it out, and we're going to remove that risk. So the commission will say, here's where we think the transmission ought to go. That'll be allocated to the utilities. And then the only proceedings were around, should you choose this route versus that route? And so that was a project that was launched in earnest at the latter part of last decade in kind of the 07 to 09 timeframe. And it was wildly successful. For a build out that, depending on how you want to define it, was somewhere between, call it $7 to $8 billion. Again, it depends how you want to define it, but I've heard people talk about the benefits have been anywhere from 25 to $35 billion. But you have to have the high voltage transmission wire in order to bring them down, and you have to build them across hundreds of miles to do so. And that's challenging because Texans, we like our property rights as much as everybody else. And so those are always very involved processes. But so far, we managed to figure out how to solve that problem here.
You know what? I did not realize there had been that legislative change. That's very interesting. And as you mentioned, very forward thinking. So you mentioned high voltage transmission lines. In the 90s, Williams Pipeline was pretty successful in converting some underutilized pipes into conduits for long distance fiber optic cables that was used in broadband transmission. Do you think that, as we transition a bit here, that existing oil and gas infrastructure could be repurposed and used in the transmission of renewable energy? Is that something that's be feasible or?
Yeah, so it's interesting. Once upon a time, when Boone Pickens was pitching to bring water down from the Panhandle into the DFW area, he was also looking at the same time with power transmission. And could you run a DC interconnection, a direct current line all the way down? And the difference between DC and AC, or the alternating current grid, is AC power basically is that's what 99% of our grid is across the United States. It's very easy to stick up transformers, substations, and tap into existing lines to pull it down. DC is really a straight shot. You need a converter to convert from AC to DC, and then you typically run a long line, and you convert it back to AC wherever it is that people are going to be consuming it. And so for various reasons, AC would be hard to stick into a pipeline. DC wouldn't. But DC requires very expensive kind of head end and conversion technologies to convert it back into the alternating current grid that dominates the state. So you haven't really seen too much of that. The right of ways for one utility, be it water or natural gas or oil or electricity, there's been a lot of talk about ways of doubling and tripling up, but we haven't really seen too much of that from a renewable perspective. We actually looked at rail at one point in time to figure out, could we actually run a line along a rail line, but there are issues associated there as well. So one of the areas that we do have an eye on, and y'all may have an eye on this as well, is we are looking at hydrogen. And again, hydrogen was, in our opinion, way overhyped back in the Bush administration. It feels like it's being overhyped again right now. But one of the benefits is it relies on a pipeline infrastructure to ultimately deliver it. And so we are looking at that to see if there are applications for that, but we still think it's further away, and we don't think it's nearly as large as what a lot of other folks do.
Yeah, that is interesting. And I learned something new today about the transmission of electricity between the AC and DC grids. Hydrogen would be a fit in pipelines. So it's all going to be, are the pipes in the right location? I think will be the major factor there. Well, I'll say you've given us quite a bit to think about. You probably have quite a bit to think about as far as your investment opportunities looking forward. And as Hunt Energy thinks about investments, do you have a target of how you would allocate investments between, say, hydrocarbons versus renewable energy sources or infrastructure?
Yeah, so it's funny. It's a great question, and I think one that I get asked quite a bit internally, and rightfully so. The short answer is we're a lot less prescriptive on that than what folks may think. In part because we talk very openly. Anybody in 2015 who basically said, I can predict what 2020 looks like, and they thought it would look like this, I'd like to meet that person, because if you go back 5
Same
years,
here.
whatever we thought was just dead wrong. But in 2010, looking forward to 2015, we would have been dead wrong. Same's true in 2005 and 2000. So we try to fight against what we call false precision all the time in terms of here's where we think things are going. Now, all that said, and y'all go through the same thing. These are the investments we make last for decades, and so you have to have a view, and you have to have a good feel for where things are going. Our approach has really been trying to understand the communities where we choose to operate. What are they trying to achieve? And internationally, historically, we've helped countries develop their natural resources. Those have been oil and natural gas plays. In those instances, we're looking for, if we get involved now, is there an opportunity for us to either expand our footprint in country or get involved in power in those countries? The U.S. is much more transnational in nature from an oil and gas perspective. On the power side, it really is about it's about delivering to end consumers electrons in the way that they want and need it. It's much more localized. You don't stick it on ships. We try to stay somewhat agnostic between, is it an oil and gas investment or is it a power or renewable investment? We do try to balance the portfolio out. We need a good foundation of what I would call more boring investments, kind of conventional oil and gas or regulated utility type investments that are more predictable or come with commodity price risk that we feel reasonably well hedging. And then we try to layer in kind of the exploitation with exploration upside opportunities or things that have higher risk and higher return. And then we still reserve a portion of the portfolio for the classic exploration wells or investments in new technologies. We're actually working on a solar perovskite technology that I think we hold over 60 patents to right now. So and that's how we try to balance out the portfolio, being more agnostic to the actual energy technology or source, but really more how does it fit into a portfolio for a private company.
Wow, that's impressive. I have to admit, and I'll tell you, it has the makings for creating a long-term business when you take that type of approach. I appreciate you sharing that.
Well, thanks, Eric. We hope so. I mean, it's again, it's fascinating to look at look at the 85 trajectory of the firm that we've had to date. And if Dad were sitting here, he would say it feels like history is accelerating. We're holding on to our seat just like everybody else is right now, trying to figure out what comes next.
Well put. Hey, well, listen, I think we've about used up the time we've been allocated. And like I said, I really do appreciate your willingness to share your insight and your perspectives, relating to what you call, and now I'm going to start calling, your energy addition. I've really enjoyed the conversation.
Well, thank you. Again, it's worth what you pay. I've really enjoyed it as well. And look forward to following this series as future speakers come on that will be far more articulate than me. So thanks.
I doubt it. As I close, I just want to remind anyone listening in that these are conversations that are hosted by the University of Oklahoma's Energy Institute. It's part of a series. So if anyone would like to listen to any of the previous conversations or future conversations, they're available through links on the website. And that's the OU Energy Institute's website. So again, thank you very much, Hunter.
No, thank you, Eric.